Wednesday, May 21st, 07:29 a.m. New York time. Welcome back, investors, to Winning Wall Street's Money. It's the middle of the week, already halfway through the month. A lot of things occurring. Past days, we had a rating agency called Moody's, one of several agencies. It's not the first, it's not the second, it's the third one, I recall. Made a press release, lower rating the U.S. government. Yep. Why? Well, current administration and current Congress want to pass legislation to lower taxes. That means they collect less revenue from tax revenue. And they want to overall increase government spending. So that shortcoming would have to be made up from selling U.S. treasuries to borrow money. And that means the tax revenue they do take in would have to pay interest on those investments. In return, we have less money being spent back for the health of the nation. Yep. So September 30th this year, the federal government will shut down if Congress doesn't pass legislation to continue funding it. It's called the CR, Continuing Resolution. That's part of what's going on now. A lot of other things going on too, affecting the financial markets. The tariffs, this has an impact. So a lot of people are concerned, deeply concerned. Selling stocks, less investment, long-term, short-term, going into stocks. And they're seeking out fixed income products that pay higher yields, but also are safer. If you downgrade, the U.S. has people questioning more on the safety of their investment. You don't know, you could invest in, or you put your capital in something like a savings account in your bank or credit union and make very little. Remember, the bank, the money you give the bank, they reloan it out at a higher interest rate, and you get very little back. Then there's money markets. And you don't have to just go to banks or credit unions. There's other financial institutions that offer these at different rates, in different states, different rates. When I say rates, I mean interest rates. You can also go into bonds. There are many different kinds of bonds. U.S. Treasury government, U.S. Treasury offers bonds. Your states, cities, counties offer bonds to raise capital to fund building bridges, upgrading roads, building schools. You also have universities, not all, that also sell bonds, such as Harvard. And Harvard raised their interest rate because they're going to get less federal government. So they're going to have to entice people to want to buy their bonds by raising interest rates. But then that means they have less money paying interest. Sorry, they have less money spent on the personal things they want at the school versus paying interest. Yeah. And there's other governments, nations that have bonds. You might look at India or South Africa to see what their current interest rates are. Or you might look at if there's one in a third world country that you have confidence that they're going to pay you back. It's not going to get overthrown. And then you have the corporate bonds, like Verizon, AT&T, Google, Walmart. A lot of these companies offer bonds, different durations. Very broad, very broad. But I'm going to focus here on the U.S. Treasury yields. Why? It's the largest fixed income bond market in the world, the best liquidity, many durations. When I mean durations, you could do buying one that's going to put you locked on for 30 years, 1 month, 1 week, many different durations. But I'm going to show you the major ones. Who buys these? Governments buy them throughout the country. Throughout the world. Yep. You don't have to be a U.S. citizen to buy these. Many other countries buy these. Governments buy these. They rather own these than own stocks. Some of them. They also have hedge funds, mutual funds, private equity investors, individuals, one-on-one. You could buy these. Many people buy the short duration ones. Also, insurance companies buy these short duration ones so they have access to capital. Instead of being locked in for 30 years, they might be buying one for 1 year. So this is a 30-year chart, meaning 30-year yield. That means this financial instrument is investment for 30 years. The chart itself is 20 years of history. But again, 30-year yield. So you'd be locking in for 30 years. This is how the rate's been. So again, the higher these are, the higher the interest is paid to you. Well, look at the top left. We are below the high of 2004. We're below the high of 2003. If you want to see the U.S. government pay less interest on borrowing money, you would want this lower. If you're an investor of these and you're looking for more income, well, then you want this to higher. The 30-year yield. Below the high of 2003. Here's the low of 2025. And here's the high of 2025. Very close to retesting 2025. We're almost done. I want to show you there's a divergency going here. Again, here's the low this year, this yellow horizontal line. Here's the high this year. This is a monthly candle. It will finish the last trading day of this month. Notice it's higher low than the prior month. Very close to the high of the year. The 30-year yield. This is the 10-year yield. Again, this is 20-year chart of history, the 10-year yield. Below the highs of 2007, below the highs of 2023. Again, look at what's happening here. The monthly candle, higher high, higher low than the prior month, but not as far as high near the year like the prior one. So again, the 30-year is closer to the high of the year. It's 10. It's not. This is the 5-year one. And 20-year chart, 5-year yield, shorter duration. It made a higher high, higher low than the prior month, much closer to the low of the year. And the 2-year yield. Yep, I told you, you buy short duration ones. You buy ones under 1 year. You buy ones under 1 month. The 2-year year. Higher high, higher low. So off the bat, I'm going to zoom in. They all have a similar thing here, that they're all making higher highs, higher lows than the prior month. They're trending up. Yield's going higher. And the longer duration one, the 30-year, is closest to retesting the high. So if you bought this at the beginning of last month, well, you bought it at a lower yield. Whereas the people that buy it now are collecting more income. So again, that's one reason some people choose the shorter duration. One more thing. Excuse me. Now we're going to look at the same financial instruments, but on shorter duration, meaning that this is weekly. So each of these candles represents a week. The current one will get done on Friday. Next Monday is a federal holiday in the United States. The Treasury will be shut down. So this is a 30-year one. 5-year chart. Each of these represent a week. Again, here we go. Very close to the highs of the year. The 10-year yield. Inside the range of last week. The 5-year yield. Excuse me, inside the range of last week. And the 2-year yield inside the range of last week. Yep. So again, it's the middle of the week. They're all inside the range of last week. I'll be looking at this at the end of the week, the close of Friday, because next week is short trading week. So if we have a reversal here, meaning if we go lower low, lower high, you expect the trend to go where? Opportunities. I'll leave it at that. Opportunities. Thank you as always, spending just a little bit of time with me. That's it for the video. Thank you for watching.